Oh, Chapter 14, Distributing Dividends and Preparing a Worksheet for a Merchandising Business. Section 1, Management Decisions Based on Financial Information. It's either going to be a profit or a loss. So profit or loss information helps an owner or manager determine future changes. Also helps with the tax reports as well. Stockholders' equity accounts used by a corporation. Corporation's ownership is divided into units. Each unit of ownership is a corporation is known as a share of stock. Owner of one or more shares is a stockholder. Many stockholders and corporations do not have a separate owner's equity for each stockholder. Single owner's equity account used for the investment of all owners is a capital stock. So instead of having multiple names for each stockholder, they just list it all under the capital stock. A second stockholder's equity account is used to record a corporation's earnings. So we know this as the net income. This increases the corporation's total stockholders' equity. An amount earned by a corporation and not yet distributed to stockholders is retained earnings. Some income may be given to stockholders as a return on their investment. A third stockholders' equity account is used to record the distribution of a corporation's earnings to stockholders. These are your dividends. Dividends is a temporary account. We would debit this and close it out to the retained earnings. So temporary accounts from Chapter 8, we'd close them out. Declaring a dividend. So the board of directors, a group of persons elected by stockholders who manage a corporation, they have the right to declare a dividend, which is action by a board of directors to distribute corporate earnings to stockholders. So in our T accounts, dividends increases on the debit, decreases on the credit, and then dividends payable. Yep, it has payable. That means it's a liability, so it increases on the credit side. Here's an example. On December 15th, Hobby Shack's board of directors declared a quarterly dividend of $2 per share. Capital stock issued is 2,500 shares, and date of payment is January 15th. So we will take our $2 per share times the number of shares, and we get our total quarterly dividend of $5,000. To journalize this, we have our dividends of $5,000 debited and dividends payable to credit. Let's do the work together. So when paying a dividend, issuing a check for the amount of the total dividend to be paid, example, January 1st, we paid cash for quarterly dividend declared on December 15th. Now we're decreasing our debt, so dividends payable is written on the debit and cash credit. So the work together, December 15th, the board of directors declared a dividend of $3 per share. Capital stock issued is 1,750 shares. So we always start off with a date, December 15th. We are going to multiply our $3 per share times our number of shares. Journalize it as dividends and dividends payable. We get 5,250 in the debit for dividends and in credit for dividends payable. January 15th, we paid cash for dividend declared on December 15th. So we're now going to decrease our dividends payable. So we have dividends payable for debit and cash credit. And that was section 1.